All right, in this lesson, we're going to start our discussion on bonds. Now, from this point forward, we're going to spend a lot of time on bonds because they can be a little bit tricky, especially if we are issuing them and how do we book them on our book. So there's a lot of moving parts. And so we've kind of broken that down into different lessons so they have a better idea of how bonds work. Now, in this lesson specifically, we're going to give you a basic understanding of how bonds work, as well as what are the key terms when we talk about bonds. And that is super important because we are going to talk about additional key terms later on, and they kind of get mixed up when we talk about bonds in general. So we want to make sure that you are fully comfortable with understanding the key terms in this lesson and in the future lessons. That way you don't mix up the key terms for one thing when it's really another. So let's get started here with helping you understand bonds. Now, bonds itself are financial instruments, which are very much like notes payable. So think of it this way. Notes payable is when you signed an agreement with another company saying that you'll pay them back with an interest amount, okay? So usually there's a direct relationship. With a bond, though, bonds usually don't have that mechanism. I mean, they do, but most often they don't because of a specific reason with these bonds. So bonds typically, the company issues them out to the public, and then the public can buy those bonds. So it's not that like there's a direct relationship. It's we're going to package these financial instruments and we're going to sell them out. And when we sell a bond, they are worth $1,000 a piece, let's say. And so if I sell you one bond, that's a one bond that's worth $1,000, and then you'll pay me you'll give me $1,000 to borrow. I'll give you the bond with an interest rate that you can get every 6 months, and then at the end of its maturity date, I will give you the $1,000 back for every bond that you hold. So they are much like financial instruments. I almost think of them like stocks. So they're like stocks. You can trade bonds. Typically, there is a public market for most major bonds, so you can buy and sell bonds on an exchange, basically. So they're very more fluid than a notes payable. Now, bonds are reported on the books just like notes payable. There are some differences which we'll go through slowly in the future lessons, but we basically book them just like notes payable into our books. Now, there are some components of bonds that are more specific than a notes payable, so we want to make sure that you understand the key terms here. So bonds are formal debt agreements with specific characteristics attached to those bonds. The first kind of thing that you should understand is that each bond will have a maturity date. This is the date in which the bond, the principal amount, payment is due. So bonds are not necessarily annuities. They are lump sum debt in which the company borrows money and you don't pay back that principal amount until the maturity date. So you're not paying along. If you borrow $1 million today and it matures in 5 years, you don't have to pay that $1 million back until 5 years from now. Now, you still will make interest payments throughout the 5 years, but the principal itself is not paid back until it matures. So that's the maturity date. When does the bond pay back? It pays back on the maturity date. Then we have the face value. The face value is what the bond is worth, and that is a important distinction here when we get into other lessons. So whatever the bond is worth, or what will be paid back, is the face value. So if the face value of the bond is $1,000, that means at the end of its maturity, so at the maturity date, the company will pay you back $1,000, or we will pay our bondholders $1,000. So what is the bond's face value? What is it going to pay out when it matures? The last one here is the stated interest rate. This is the interest rate that interest will be based on for that bond. So on the bond, it will say how much the bond is worth. It will say what's the interest rate, and then what's the maturity date. So this interest rate is what the company is going to pay in interest based on the face value. So if I said that we were going to issue a $1,000 bond with a 10% stated interest rate, then we would be obligated to pay interest of $100 each year. 1,000 times 10% is $100. So we will pay $100 to the bondholder every single year. And usually we pay twice a year, every 6 months. So every 6 months we're paying $50 for the borrowing of those funds that make up that bond. So maturity date, the date when it's due, when the principal's due. Face value is what the bond's actually worth, and then the stated or the interest rate is what interest rate we are going to pay on the bond. Okay. Now, besides the bond's formal components, there are some investment components that we need to understand. So make sure you understand the last three terms, because I'm going to turn it around here in this slide here. So thinking about other terms that you should be aware of. The first one is bond pricing. This is the price at which it is issued to the public and or the amount it is currently worth in the secondary market. So the way that you should think about this is that a bond is issued usually for $1,000. So that's what the bond's worth. But because of how the market's interest rate works, you might not be able to get $1,000 for your bond. You might have to sell it for $950. It's still going to pay out $1,000, but you're selling it for $950. Why? To get people to buy. So the bond's price might be $950, but the bond's worth is $1,000. So if you bought this bond for $950, when it matures, you'll get $1,000. So you get what the bond that face value is. You're not going to get what the bond price is. Now, could the bond sell for more than it's really worth? Absolutely. It could sell for $1,015, but again, at maturity date, it will only pay out $1,000. It's face value. So bond pricing. Now, there's three types of ways that it can be priced at, either in the primary market when it's first sold, or the secondary market where participants buy from each other. The first one is at a discount. So it could be sold at a discount, which is less than its face value. It could be sold at face value, which is exactly what the bond's worth. And then it can also be sold at a premium, meaning that it's selling for more than what its face value is. So those are your three options when it comes to bond pricing. And again, it's going to be based on the interest rate out in the market. Interest rate. So we talked about the stated interest rate. That's what the interest is that's what the bond's going to pay in interest. The market interest rate is the effective interest rate based on bond pricing and the interest attached to the bond. What does that mean? Well, if a bond is issued at a discount, meaning that you buy it for $950, but the bond's worth $1,000, it's still going to pay you that 10% a year, but at the very end, you're going to get $1,000, so you're going to get $50 more. So that $50 acts as additional interest, which increases the interest rate because you're going to get $50 for free, basically. So that is, if we take that extra $50 plus the 10% and calculate an effective interest rate, we would get the market interest rate. So the market interest rate represents what you're actually getting from an interest rate standpoint, including the discount or minusing the premium. If it's face value, the market rate and the stated rate will be the same. All right. So those are some of the basic understanding of bonds. I know that's still maybe a little bit fuzzy, but we want to give you that first initial understanding of bonds. We'll continue to talk about it as we go further in this section. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.